Institutions just moved $85 million into XRP in a way most retail investors completely missed. And according to some of the smartest institutional minds in crypto, XRP has already won this race. People just don't realize it yet. Canary Capital CEO said something about Ethereum that should terrify its holders, and it explains exactly why institutions picked XRP instead. Let me show you what's really happening here, because this goes way deeper than just another ETF launch or price pump. We're talking about institutional money making permanent bets on infrastructure, not speculation. XRP is being woven into the financial system at a level that's honestly hard to reverse at this point. By the end of this video, you'll understand why the smartest money in traditional finance looked at every option and landed on XRP for the long term. And if you're holding XRP right now, this might be the most important thing you watch this month. If this breakdown adds value in the first few minutes, go ahead and tap that like button. It helps me bring you more institutional insights like this. So, let's start with what just happened that most people scrolled past. CME Group launched XRP futures. Now, if you don't know what that means, CME is the largest derivatives marketplace in the world. They don't launch futures for coins they think will disappear in 2 years. Futures contracts mean institutional traders can now hedge positions, which means they're taking XRP seriously as a long-term hold. You don't build hedging infrastructure for a speculative trade. You build it for assets you plan to hold through market cycles. And right after that, Vanguard, one of the biggest asset managers on Earth with 50 million clients, started offering XRP ETF access, not through some small firm. Vanguard, the company that manages over $7 trillion. Then you have Canary Capital's XRP ETF going live on NASDAQ. But here's the part that should make you pause. Since launch, XRP ETFs have seen $85 million in inflows and exactly zero in outflows. That means institutions bought in and not a single one sold. Compare that to other crypto ETFs where you see constant in and out volatility. This is conviction buying. And on top of all that, the XRP ledger has processed over $10 billion in real-world settlements, not testnet transactions. Real money moving through real payment corridors right now. But the ETF inflows and the futures, that's just institutions getting positioned. What matters more is why they chose XRP in the first place. And that's where things get interesting. So, here's what you need to understand about institutional adoption. These aren't retail traders chasing 10x gains. These are banks, payment processors, and asset managers who need technology that actually works at scale. XRP processes transactions in 3 to 5 seconds. Settlement is final. The cost per transaction is fractions of a cent. Now compare that to what they were using before or what they considered using. Bitcoin handles about 7 transactions per second. Ethereum, even after all its upgrades, still has gas fees that spike during congestion. For a bank moving millions of dollars across borders multiple times per day, those limitations aren't just inconvenient, they're disqualifying. And this is where it gets even more important. Institutions don't just need fast and cheap. They need regulatory clarity. XRP has been through the legal gauntlet and came out the other side with a framework that institutions can actually work within. No other major crypto asset has that level of clarity in the US market right now. So when a bank's legal team is evaluating what they can build on, XRP is one of the only options that doesn't come with massive compliance risk. That's why you're seeing real partnerships, not just announcements. Payment corridors between the US and Mexico, the US and Philippines, Europe and Asia. These are live moving real money today. Let me give you a specific example. Standard Bank is using this for cross-border payments. Shinhan Bank ran a stable coin remittance pilot. These aren't press releases about future potential. These are banks that tested the tech, saw it work, and moved forward. And here's the thing. Institutions care about that retail often misses. It's not just about speed or cost. It's about finality. When a payment settles on the XRP ledger, it's done. There's no rollback risk, no confirmation waiting period that could fail. In traditional banking, cross-border payments can take 3 to 5 business days and still fail at the last step. With XRP, it's 3 seconds and irreversible. If you're a CFO managing liquidity for a multinational company, that difference is everything. And if you're starting to see why this matters for long-term value, make sure you're subscribed because I break down institutional crypto moves like this every week and most of them fly under the radar until it's too late. Now, let's talk about scalability because this is where the already won argument really starts to make sense. Bitcoin can do 7 transactions per second. Ethereum, depending on layer 2 solutions, might get you to a few thousand. XRP Ledger can handle 1,500 transactions per second right now. And with payment channels, it scales even further. But here's what most people miss. It's not just about theoretical throughput. It's about proven throughput under real-world conditions. The XRP Ledger has been running for over a decade without a single hour of downtime. No halts, no rollbacks, no emergency maintenance. For an institution building critical payment infrastructure, that track record matters more than any white paper promise. And then you have energy efficiency. Bitcoin mining consumes more energy than some countries. Ethereum, even after the merge, still requires significant resources. XRP uses a consensus mechanism that's so energy efficient, it's basically negligible. For institutions facing ESG requirements and carbon reporting mandates, that's not a nice to have. It's a must-have. You literally cannot pitch a Bitcoin-based payment solution to a board that has net zero commitments. You can with XRP, and institutions know this. That's why when you look at who's actually building real-world payment infrastructure, they're not choosing proof-of-work chains. They're choosing efficient, scalable, proven technology. Which brings us to central banks, because that's where this story gets even bigger. So, the Digital Monetary Institute. This is a global network of central banks, financial institutions, and payment providers, just brought XRP into its ecosystem as they explore CBDCs, central bank digital currencies. Now, here's why that's a massive deal. Central banks aren't experimenting with retail speculation coins. They're looking at infrastructure that could potentially support a digital version of their national currency. The Reserve Bank of Australia ran CBDC pilots. The Bank of England has been exploring distributed ledger tech for settlement. Wyoming is launching a stablecoin. And behind the scenes, XRP ledger technology is part of these conversations, not because of hype, because it works. When a central bank evaluates technology for CBDC infrastructure, they have a checklist. Can it scale to handle an entire nation's transactions? Yes. Is it energy efficient enough to meet modern standards? Yes. Is there regulatory clarity? Yes. Can it settle instantly? Yes. Has it been stress tested in real-world conditions for years? Yes. That's not speculation. That's why institutions are choosing XRP. And here's the part that should make this click. Once a central bank builds infrastructure on a particular ledger, they don't just switch it out next year because a new coin pumped. Infrastructure decisions are 10, 20, 30-year commitments. If XRP becomes part of the backbone for even a few major CBDC projects, the network effects become almost impossible to compete with. But let's bring this back to something you can see right now because I don't want this to feel hypothetical. Real-world settlement volume. The XRP ledger processes billions of dollars in actual cross-border payments annually. Not partnerships announced, not pilot programs planned, money moving today. And the volume is growing. You have payment corridors in Asia, Latin America, Europe, and Africa. Some of these corridors are processing hundreds of millions per month. And every transaction proves the system works. Every settlement builds more confidence. Every quarter of uptime makes it harder for a competitor to argue they can do it better. Here's a number that should stick with you. Over $10 billion in real-world settlements on the XRP ledger so far. That's not DeFi trading volume or NFT marketplace activity. That's banks, payment processors, and enterprises moving real money for real business purposes. And once you have that kind of volume flowing through infrastructure, switching becomes incredibly expensive and risky. Would you rip out a payment system that's processing billions of dollars a month smoothly just to try something new? Of course not. That's the moat, and it's widening every single day. Now, here's the question institutions are asking that retail usually misses. I'll tell you what it is and why it changes everything in just a moment. All right, so here's the question institutions ask that retail almost never considers. If we build on this technology, can someone just fork the code and recreate it? And this is where Canary Capital CEO said something that should make every Ethereum holder nervous. He said, and I'm paraphrasing here, that JP Morgan looked at Ethereum, liked what it could do, and then just took the code and built their own blockchain. JPM Coin runs on a private version of Ethereum's tech, but it's not on Ethereum. The bank didn't need the ETH token. They didn't need the public network. They just copied the open source code and built their own. And that's the problem with expensive to run open source protocols. If the code is free and the network is expensive, institutions will just rebuild it themselves. XRP is different. It's not just about the code being open source. It's about the network effects, the liquidity, the existing partnerships, and the regulatory clarity that comes with the XRP ledger. Specifically, you can fork the code, sure, but you can't fork the fact that banks in 40 countries are already integrated. You can't fork the liquidity pools that took years to build. You can't fork the regulatory clarity that came from years of legal process. And you definitely can't fork the trust that comes from a decade of perfect uptime. So when an institution looks at XRP, they're not just evaluating software. They're evaluating an entire ecosystem that's already operational. That's the moat that can't be replicated. And that's why Canary Capital, when asked what institutions are focusing on, named XRP first before even talking about other chains. He said institutions are looking at XRP, Hydera, Solana, technologies that are cheap and efficient to run. They don't want to build on expensive chains anymore. They want infrastructure they can actually use at scale without bleeding money on gas fees. And among those options, XRP has the longest track record, the clearest regulations, and the most existing integrations. It's not the newest. It's not the trendiest. But for instance, that's exactly the point. They don't want experimental tech. They want proven infrastructure. And XRP has been proving itself for over a decade, while others were still writing white papers. So, if you're finding value in this breakdown and you want to stay updated on institutional crypto moves, go ahead and subscribe now. This kind of analysis is what I focus on every single week, and it's the stuff that actually moves markets long-term. Let's talk about what this means for price discovery, because this is where it gets interesting. Retail traders think about crypto in terms of pumps and dumps, bull runs and bear markets. Institutions think in terms of infrastructure builds and 10-year capital deployment. When Canary Capital's ETF bought over 500 million XRP tokens and now holds 1% of the total supply, that's not a trade, that's a position. When ETF inflows hit 85 million with zero outflows, that's not speculation, that's conviction. Institutions don't buy to sell next week. They buy to hold through cycles because they believe the underlying infrastructure will be essential. And here's the part retail often misses. When institutional money enters, it doesn't leave the same way retail does. Retail panics at 20% drops. Institutions see 20% drops as noise in a multi-year thesis. So, what happens to price when institutional capital locks up supply? Basic supply and demand. If 1% of XRP supply is sitting in Canary's ETF and Vanguard's 50 million clients now have access and more ETF products keep launching, that's supply getting absorbed by hands that won't sell on the next dip. And while retail is watching daily candles, institutions are watching adoption metrics. How many payment corridors went live this quarter? How much settlement volume increased? Which new banks integrated? Those are the numbers that tell them whether their thesis is playing out. And right now, every single one of those metrics is moving in the right direction. More corridors, more volume, more integrations. That's why the smart money isn't worried about short-term price action. They're positioning for where this goes in 5 to 10 years. Here's a data point that should make this clear. From October through February, XRP ETFs saw consistent monthly inflows. 44 million in October, 36 million in November, 3 million in December, 6 million in January, 1 million in February. That's 5 straight months of net buying. No months without flows. And this is happening while the broader crypto market has been choppy and uncertain. That tells you institutions are buying on fundamentals, not momentum. They're not waiting for a bull run to get in. They're accumulating while prices are still reasonable before the mainstream realizes what's being built. And if you understand that, you understand why people say XRP has already won. It's not about the current price. It's about the infrastructure that's already locked in. Now, let's talk about the timeline nobody's discussing, because this is where the thesis either clicks for you or doesn't. We're still in the early infrastructure phase of institutional crypto adoption. Central banks are running pilots. Payment companies are testing corridors. Asset managers are launching ETFs. This is the build-out phase. The next phase is full deployment. That's when the payment corridors that are processing millions today start processing billions. When the CBDC pilots turn into national rollouts. When the ETFs that hold 1% of supply expand to 3%, then 5%, then 10%. And here's the critical part. Once that infrastructure is live, it doesn't get torn out. A bank that spends 2 years integrating XRP for cross-border settlements isn't going to rip that out in year 3 to try something else. The switching costs are too high. The risk is too high. The opportunity cost of downtime is too high. So, if you're holding XRP today, you're not holding a speculative token hoping for a pump. You're holding infrastructure that's being woven into the financial system while most people are still trying to figure out what blockchain is. And that's the already won thesis in a nutshell. It's not that the price has already peaked. It's that the institutional adoption race is over. XRP won. The partnerships are signed. The infrastructure is deployed. The regulatory clarity exists. The competition can't catch up because the moat is too wide and getting wider every quarter. Now, some people will argue that other chains are faster or newer or have better tech, maybe. But institutions don't care about better in a vacuum. They care about proven, regulated, integrated, and operational. And XRP checks every single one of those boxes. Let me give you a mental model for understanding this. Think about cloud infrastructure. AWS launched first. Is it the best cloud platform from a pure tech perspective? Debatable. But AWS has so much market share, so many integrations, so much enterprise trust that even if a competitor launched something technically superior tomorrow, it wouldn't matter. The switching costs are too high. Enterprises have built entire systems on AWS. Moving would take years and millions of dollars. That's the position XRP is building in cross-border payments. It's not the newest, it's the incumbent. And in infrastructure plays, the incumbent with network effects is almost impossible to displace. That's why institutions are buying now, not waiting to see if something better comes along. They've evaluated the options. They've made their choice. And that choice is showing up in ETF inflows, CME futures, CBDC pilots, and billions in settlement volume. Here's another angle most people miss. Institutional adoption isn't binary. It's not like one day banks aren't using XRP and the next day they are. It's a gradual process. First pilot programs, then limited production, then scaling, then full deployment, then integration into core systems. We're somewhere in the middle of that process right now. Some banks are in pilots, some are in limited production, a few are scaling. But here's what matters. Nobody's moving backward. Every quarter, more institutions move further along that adoption curve. And every institution that moves from pilot to production makes it easier for the next one to justify doing the same. That's how infrastructure adoption works. It's slow, then it's everywhere. And right now, we're in the slow phase that's about to tip into everywhere. If you can see that, you understand why long-term holders aren't worried about daily price action. Now, before we wrap this up, let me address the question you're probably asking. If this is all true, why isn't the price 10x higher already? Fair question, and the answer is that infrastructure value and speculative price don't move in lockstep. Retail traders price in hype and momentum. Institutions price in long-term utility and cash flow. Right now, the market is still mostly retail-driven. But as more supply gets locked up in ETFs, as more institutional capital flows in, as more treasury allocations happen, the price mechanism shifts. It stops being about what retail thinks and starts being about what institutions are willing to pay for strategic infrastructure exposure. And when that shift happens, and it's already starting, price discovery looks very different. You won't see 50% pumps in a week. You'll see steady grinding upward pressure as supply gets absorbed and new demand keeps coming. That's what institutional accumulation looks like. It's not exciting, but it's incredibly effective. Let me tie this all together because this is the part that should stick with you. XRP's institutional adoption is irreversible at this point. The partnerships are signed, the infrastructure is deployed, the regulatory clarity exists. The competition can't catch up because the moat is too wide and the switching costs are too high. You can argue about whether XRP is the best technology in some abstract sense. But in the only sense that matters, what institutions are actually choosing to build on, XRP has already won and the smart money knows it. That's why ETF inflows have been consistent with zero outflows. That's why Canary Capital increased its position to over 530 million XRP. That's why Vanguard gave 50 million clients access. That's why CME launched futures. These aren't speculative bets. These are infrastructure plays. And infrastructure plays with 10-year time horizons don't get unwound because a new coin pumped this month. So, if you're holding XRP, understand what you're holding. You're not holding a lottery ticket. You're holding a piece of infrastructure that's being woven into the financial system. And if you're not holding XRP, but you've been watching from the sidelines, understand that the window where institutions are still accumulating at reasonable prices doesn't stay open forever. At some point, the infrastructure phase ends, the deployment phase begins, and price discovery reflects that shift. We're not there yet, but we're getting closer every quarter. And by the time it's obvious to everyone, the opportunity will have already moved. That's how institutional adoption works. It's quiet, then it's loud. And right now, we're still in the quiet phase. The question is whether you're paying attention. If this breakdown gave you a new perspective on what's actually happening with XRP, I'd love to hear your take. Do you think institutional adoption is the real driver here? Or is there something else the market's missing? Drop your thoughts below. And if you want to stay ahead of moves like this before they become mainstream news, make sure you're subscribed because I cover institutional crypto every week. Thanks for watching. I'll see you in the next.